the S&P 500 index, and the next bear market. It has been several years now since I've established an interest in the market and investments. I'm aware that in order to really develop a financial secure future, investing is necessary. Just working a job will never provide the financial freedom you desire for you and your family. So, as I began to educate myself on the topic, I found that investing in stocks is definitely the best way to establish financial success if done intelligently. This topic for me is definitely a passionate one. The specific area of interest I've selected, as I mentioned above, is the stock market, but the market is a very broad term. What I'm specifically focusing on is the Standard & Poor's Index 500, which is an index that keeps track of 500 publicly traded U.S. businesses listed in that specific index. The index itself specifically measures the fluctuation of the average of prices of all 500 businesses in the S&P 500 over time. There is roughly a century's worth of data for this index. This is substantial for analysis of the behavior of the S&P 500, which is my main focus with my project. The central goal of my project is to create a mathematical model that represents the S&P 500's historical behavior. With it, I can then analyze the general performance over a century and use this information to help me determine when we might have another bear market, a term used to describe when the market's overall pattern is downward. This will be the core focus of my research question. When will the next bear market occur? So why is this question important? The market can only move in one of three ways: upward, downward, or sideways. The overall trend of the market over the century has generally been upward, but there have been many moments in our history when the market has had significant downward movements. These downward movements can be very drastic and can last for years. So being able to anticipate such a change in the market can be very beneficial to investors and have potential to make lots of money. This is the entire purpose of this project, to see if we can somewhat accurately predict the next significant downward movement in the S&P 500 index. I say somewhat accurately because we can never accurately predict the future, especially of the market. But we can definitely use this historical data of the market to assist us in better understanding the behavior of the market and use it to make an educated guess of its future behavior. Modeling the S&P 500 index. When it comes to the market, the data is straightforward: date, price, and volume. So for that specific trading day, we have a volume of trades that occur, both selling or buying, and the price then fluctuates either up or down for that day. Then the same occurs for the next trading day. Over time, we can then analyze the trend of the market: upward trend, bull market; downward trend, current correction or bear market; or sideways trend, neither up nor down. My overall goal with this project is to create a model that can then assist me in analyzing the performance and specific activity that can cause a market to move into a particular trend. Here we are particularly concerned with the corrections and bear markets. The method I plan to use is linear regression. Using this model and plots to analyze the data with a little bit of statistics, I feel very confident I can then use this information to help me answer my research question. More specifically, I plan to rigorously analyze the behavior of the market just before corrections/bear markets to help me identify any patterns that may be correlated with corrections/bear markets. This can then maybe help us identify the next correction/bear market just as it begins. The other part of my analysis is to use historical data to identify how often corrections and bear markets occur and use this information to assist me in determining when the next one may occur somewhat accurately. The overall analysis will definitely help me in answering the research question: when will the next bear market occur? As I've already mentioned, the model type that I've selected for the project is a linear regression model. The limitation here is that we need to assume that the S&P 500 index behaves in a linear manner, but this is obviously not the case. In order to appropriately apply the linear regression, I then chose to break the index into chunks that are 6 months long or less. Then apply linear regression to each section and analyze the results. Creating the model. To begin, I first broke the market into 6-month chunks and ran the linear regression software for each 6-month datasets. An example is shown here. There are 2 reasons for using linear regression for creating the model. One, in a 6-month chunk of the market, one can see that it behaves linearly. And second, a linear regression model was a more appropriate option for the time allotted for the project and for the experience I possessed. The results provided a summary and ANOVA for each chunk of the index. The slope for each regression line, R squared value, and P value are shown in the chart. A large part of my analysis was looking at the patterns of the slope as the market would approach a correction or bear market. The slope specifically identifies the rate of change of the price of the S&P 500 index over time. In this case, the slope represented the rate of change of the index price for the specific 6-month period. The R squared value that determined how much of the variability in the independent variable is predicted through the model, where the P value helps test whether the regression is working in general, since it analyzes how well of a fit the model is. Analyzing the volume. The manner in which I analyzed the historical data of the volume of the index was very different than that of the price. By simply glancing at the volume, one can easily see that the market's activity significantly increased over time. My goal with analyzing the volume was to study the activity of the market right before a correction and bear market. I wanted to see if there was an increase, decrease, or no significant change in the volume relative to the average. But by taking the average of the volume over 67 years would not provide an accurate depiction of the market's volume over time, over each time period. For example, the S&P 500 index average volume over 67 years was roughly 1.8 times 10 to the 10, when the volume recorded on the 1st of October 1950 was 4.8 times 10 to the 7, a notable difference. To fix the issue, I then broke the market into 5-year chunks and took the average of the volume for each chunk. I would then use the relative volume to estimate the activity of the market right before a correction and bear market. This provided a more accurate depiction of the market's activity for each specific time period. The final part of the process was extracting useful information from the report by Yardeni, Stock Market Briefing, S&P 500 Bull and Bear Market Tables. This report provided tables of information of the S&P 500 index. The table in which I was particularly interested was that of the corrections and bear markets. The table illustrated here. This table provided information of the corrections and bear markets since 1928. Peak date through date, peak price through price, percent loss, and number of days. This was a pool of extremely useful information. With it, I was able to determine historical patterns, trends, and averages of the index. The results. The analysis process was rigorous and definitely required attention to detail. After creating the linear regression models and collecting the information presented in the summary and ANOVA for each 6-month period, I first used the information to determine whether the model fit the data and test whether the regression was working. After removing a few outliers in the data, I was able to establish a model that fit the data. The average R squared was 0.8170 and the average p-value was 0.0536. The R squared value tells us that about 82% of the variability of the data points in the model is represented by the regression line. And the p-value tells us how meaningful the model is in representing the data. The goal with the p-value is to have it less than or equal to 0.05, which we were very close at 0.0536. With these values for the R squared and the p-value, I was more confident in using the information collected from the model for analysis. The slope of the regression line was a significant piece of information in my analysis. With it, I was able to identify particular trends of the market just as it approached a correction or bear market. This trend would then assist me in identifying whether or not we were currently approaching a correction or bear market. Before the sensitivity analysis, I calculated the average slope of the model for the 12 months prior to both a correction and bear market to be 0.2612. But after removing the outliers from the model, I found the average to be 0.2025. A similar result occurred with the analysis of the volume. By taking the volume compared to the 5-year average for its specific period, I was able to get a more relative understanding of the activity of the market as it approached a correction and bear market. Before the sensitivity analysis, I found the average activity of the market to be roughly 9.3% more than the relative 5-year average. But after removing the outliers from the data, I found the average to be roughly 5.5% more than the 5-year average as the index approached a correction and bear market. Limitations and assumptions. Though I have listed a few assumptions and limitations in my model earlier in the report, it is interesting to see if any new limitations appeared during the process of the model and analysis. We must understand that too many assumptions make the model too basic to the point where it would not accurately depict the behavior of the market. And we must understand and have a complete awareness of the fact that mathematical models are not meant to represent reality with 100% accuracy. Most of life situations are much too complicated and have too many factors to consider when establishing a mathematical model that depicts its behavior, such as the market. So assumptions are usually inevitable and do add limitations. The first limitation is how current events or the fear of how these events can strongly influence the market, such as presidential elections, natural disasters, wars, etc. In my model, I must assume that these events do not influence the market. The next assumption is concerned with the overall behavior of the market. By looking at the historical data of the market, one can quickly identify its non-linear behavior. In my model, I made the assumption that the market takes on a linear demeanor. Since I plan to zoom into relatively small sections of the market that are no larger than 6 months, the market tends to behave more linearly the closer you get, so to speak. The last limitation I need to highlight about my analysis is the overuse of the average. Though the average is a powerful tool to use in statistics and analysis, the overuse of it can certainly take away from the accuracy of the model, at least in my opinion. The average has definitely assisted me in better understanding the behavior of the market for the past 67 years, and it also assisted me in predicting somewhat accurately the behavior of the market in the near future. But I must admit, the average may have made the analysis of the market more basic than what I would have liked. This definitely was a limitation to the model. Approach and applicability. The purpose of this project was to model the S&P 500 index and use the collected data and its analysis to answer the established research question: when will the next bear market occur? By analyzing the behavior of the price and volume just before the market enters a correction or bear market and comparing these patterns to the current behavior of the market, specifically the last 12 months, I found no similarities. More specifically, the general behavior of the rate of change of the index is an average of $0.2025 per month for the 12 months approaching a correction or bear market. When looking at the market's activity 12 months before a correction or bear market, we see a general increase of volume of 5.5% compared to the 5-year average. When taking these trends and comparing them to the last 12 months, specifically from September of 2016 to October of 2017, the average rate of change of the slope has been $1.1952 per month, and the average volume has only been 92% of the 5-year average. This must mean that the market will not be entering a correction or bear market anytime in the near future. And according to the analysis of the data from the research report, I found that a bear market comes at an average of every 7.4 years. Since the last bear market was from October 2007 to March 2009, we are definitely past due for a bear market. But looking more closely at the data, the longest we've gone between bear markets has been roughly 12 years. So we can then expect a bear market sometime between now and no later than 2021. Yet the analysis provided more useful results. Roughly for every 10 downward market trends, 6 are corrections and 4 are bear markets. Since we've had about 4 corrections so far since the last bear market, this tells us that we may experience 1 or 2 more corrections sometime within the next few years before hitting the next bear market. Nonetheless, we are definitely due for a bear market sometime within the next 4 years. Another interesting note to make from the analysis is that we should be expecting another correction sometime between now and November 2018. And if we do enter this correction, the probability that the correction will evolve into a bear market is roughly 66.7%. As I mentioned in the beginning of the report, we can never predict the future with 100% accuracy, and this project would only provide a somewhat accurate prediction as to when the next bear market would occur. So did the model and analysis of the data provide an answer to the research question within the boundaries of its limitations? Yes, it did. Either way, it is quite interesting and exciting to see what the future holds for the market and the economy. We need to remember that the market's historical behavior shows that it goes up and down, but the overall general trend has always been upward. So in my opinion, no matter how many corrections or bear markets we face, the future is definitely bright for the economy.